Welcome to AminAcademy.com. In mathematical economics, let us discuss about market equilibrium, some introduction. Equilibrium literally means balance. It means a position from which there is no tendency to change. The forces which determines it can said to be in balance at the equilibrium point. Unless these forces changes, the equilibrium would not change. Equilibrium price then is the price at which the forces which determine the price are in balance. The two forces which determine the price of any commodity in the market are demand and supply. Geometrically, this is the price where the demand and the supply curves cross. If we let D of P be the market demand curve and S of P the market supply curve, the equilibrium price is the price P that solves the equation D of P equals S of P. The solution to this equation P is the price where market demand equals market supply. When market is in equilibrium, then there is no excess demand and supply. Now, let us discuss further detail regarding this concept. Market equilibrium, some introduction. Look at this curve. This is a quantity in x-axis, price in y-axis. This both supply curve and demand curve, where it cut the point that is called equilibrium point. The market equilibrium is the economic state where the quantity of a good or service that consumers want to buy, that is demand, is equal to the quantity that producers want to sell, that supply, at a specific price known as the equilibrium price. At this point, there is no shortage or surplus, and the market naturally tends to remain stable without external pressures, making it a state of balance. Demand. Suppose demand, the amount of good or service that consumers are willing and able to buy at various prices. This D of function is D of P. And supply, the amount of a good or service that producers are willing and able to sell at various prices. That is selling curve S of P. At equilibrium price, the price at which the quantity of demand perfectly matches the quantity of supply, that is D of P should be equal to S of P. By solving this equation, we can get the price, that is the equilibrium price. Equilibrium quantity, the specific quantity of the good or service that is both demanded and supplied at the equilibrium price. How it works? Above equilibrium price, that is surplus, if the market price is too high, producers will supply more goods than consumers want to buy, leading to a surplus. To get rid of unsold goods, sellers will reduce price, which in turn increased demand. So this is a surplus area, that is shortage area. Below equilibrium price, that is shortage, if the market price is too low, demand will exceed supply, creating a shortage. Consumers will compete for the limited goods, and sellers will realize they can raise prices to make higher profits, leading to price increase and a reduction in demand. The market will naturally adjust through these prices changes until the quantity demanded equals the quantity supplied, then equilibrium is reached. So far we discussed some introduction about market equilibrium in mathematical economics. We have done. Please subscribe our YouTube channel.